Lack of diversification. Why putting all your eggs in one basket is a risky move. Investing is an essential step on the path to financial growth and security. However, as a beginner investor, there's one key principle you need to master early: diversification. What does it mean? Why is it so important? And how can you apply it effectively within your investment strategy? In this video, we're breaking it all down to set you on the right path towards smarter, safer investments. Let's start with the basics. Diversification is an investment strategy that spreads your money across multiple assets, industries, and even geographic regions with the goal of reducing risk. You've likely heard the saying, "Don't put all your eggs in one basket." That's exactly what diversification addresses. If you put all your eggs or your money into one stock, bond, or industry, you're fully exposed to risks if something goes wrong. Diversification ensures that not all parts of your portfolio are affected by the same market conditions, reducing the likelihood of severe losses. When done right, diversification is more than just a risk reduction tool. It also opens doors to consistent, long-term growth. By balancing your investments across a variety of options, you increase the likelihood that at least some of your portfolio performs well, even during challenging times. Failing to diversify your investments comes with high stakes. Imagine pouring all your savings into a single stock that happens to be performing well today. It might seem like a strong bet, but what if that company hits a financial setback? What if market conditions change overnight? Without diversification, your portfolio could be wiped out in an instant. Market volatility, fluctuations in the value of investments, is inevitable. A concentrated portfolio, one focused on a single stock, sector, or region, is inherently vulnerable to market swings. For example, the technology sector might face disruptions due to supply chain issues or regulatory changes. Without investments in other industries or asset classes, your portfolio would bear the full brunt of that downturn. We can also consider geographic concentration. Investing solely in your home country may feel familiar and safe, but it leaves you open to country-specific economic downturns. Whether it's political instability, natural disasters, or a faltering economy, being geographically concentrated means your portfolio is entirely subject to local risks. In short, putting all your money into one investment, or even one type of investment, isn't just risky, it's unnecessarily risky. Diversification is your shield against the uncertainties of investing. By spreading your investments, you reduce your overall risk while giving yourself greater opportunities for rewards. Let's break this down further. Risk mitigation. If one investment suffers losses, the others in your diverse portfolio can act as a cushion, minimizing the overall impact. Consistent performance. By diversifying across different sectors and asset classes, you can reduce the volatility in your portfolio. Certain investments may outperform while others underperform, balancing each other out over time. Access to growth opportunities. By investing in various markets, both domestic and international, you take advantage of global growth trends and prevent over-reliance on the economic conditions of one region or industry. Ultimately, diversification gives you stability, a safety net, and the ability to ride market trends. It's a simple yet powerful tool that every investor, especially beginners, should embrace. Now that we've established why diversification matters, let's focus on how you can put it into practice. Here are 3 key steps to building a diversified portfolio. An asset class refers to a category of investments that share similar characteristics. Common asset classes include stocks, bonds, real estate, mutual funds, and even cryptocurrency. By allocating your investments across multiple asset classes, you reduce the risk of poor performance in one area affecting your entire portfolio. Let's break this down. Stocks. Investments in companies offer the potential for high returns but come with higher risk. Bonds. These are generally less risky and provide steady interest income, balancing the volatility of stocks. Real estate. Properties can generate both rental income and appreciation over time, adding a different dimension to your portfolio. Cryptocurrency. Though highly volatile, a small allocation can complement a diversified portfolio for potentially high rewards. Step 1 is about balancing risk and reward. Aim to allocate your money across these asset classes based on your financial goals and risk tolerance. Even within an asset class like stocks, it's important to diversify further. The performance of industries such as healthcare, technology, energy, and finance varies based on market conditions. For example, the energy sector may prosper when oil prices are high, while the tech industry might face challenges due to regulatory shifts. A good tip for beginners is to explore different sectors to ensure a single event in one industry doesn't entirely derail your portfolio. Diversifying across sectors also gives you exposure to different trends, helping you capture growth across the board. While it's tempting to stick to what you know, often companies in your home country, doing so can limit your portfolio's growth and increase your risk. Different markets around the globe perform differently at various times, offering great opportunities for diversification. For example, while one country's economy is slowing, another's could be expanding rapidly. By including international stocks, bonds, or funds, you're not just protecting against regional economic downturns. You're also opening the door to participate in global growth. Diversifying from scratch can feel overwhelming, but there are investment tools specifically designed to make the process easier. Let's look at 3 of the most common. Exchange-traded funds, ETFs. ETFs pool money from many investors to invest in a wide range of assets. By buying shares of an ETF, you gain exposure to multiple companies, industries, or markets instantly. Mutual funds. Similar to ETFs, mutual funds also pool investor money, but they're actively managed by professionals to maximize returns. These funds are an excellent resource for beginners who want instant diversification while relying on expert oversight. Index funds. These funds mimic the performance of a market index like the S&P 500, offering a low-cost way to invest in a broad range of companies. Each of these options is beginner-friendly and can form the foundation of a solid diversified portfolio. Creating a diversified portfolio is just the first step. To ensure long-term success, you'll need to regularly revisit and rebalance your investments. Rebalancing is the process of adjusting your portfolio to maintain your desired level of diversification as market conditions change. For example, say one asset class, stocks for instance, performs exceptionally well and grows to make up a disproportionate amount of your portfolio. Rebalancing would involve shifting some of that capital into other asset classes like bonds or real estate to restore balance and reduce risk. This practice ensures that your portfolio aligns with your financial goals, market changes, and personal risk tolerance. Think of it as giving your investment strategy a regular tune-up. Let's address some common misconceptions about diversification. Myth 1. Diversification guarantees profit. While diversification reduces risk, it doesn't eliminate it entirely. It's a key component of a sound investment strategy, but market dips can still happen. Myth 2. A small portfolio can't be diversified. Even with limited funds, tools like ETFs and index funds allow you to achieve diversification practically and affordably. You don't need to be a millionaire to spread your assets. Myth 3. Over-diversification is always better. While spreading investments is crucial, spreading them too thin can dilute your returns and make managing your portfolio more difficult. Striking the right balance is key. Let's consider 2 contrasting examples to reinforce the importance of diversification. Case 1. The danger of no diversification. An investor puts all their savings into a single technology company's stock. When that company unexpectedly reports losses, the stock value plummets, wiping out a significant portion of the portfolio. Case 2. The power of diversification. Another investor splits their funds across several sectors, including technology, healthcare, and bonds. When the tech sector falters, the impact on their portfolio is minimal because their other investments perform steadily. These scenarios clearly demonstrate how diversification can protect and grow your investments over time. Diversification is one of the most important investment principles for any beginner to grasp. By spreading your investments across different asset classes, sectors, and regions, you reduce risk, improve stability, and ensure your portfolio has the potential for long-term growth. Remember, investing isn't about chasing quick wins. It's about building sustainable wealth. Diversification gives you the tools to achieve just that. So start today, apply these strategies, and take your first steps toward becoming a smarter, more confident investor. Diversification is one of the simplest yet most effective strategies to reduce risk and protect your investments. If you found today's video helpful, please hit the like button and subscribe to Online Investment Compass for more tips on building a balanced and resilient portfolio. Let me know in the comments if you have any questions about diversification, or if you'd like me to cover other investing strategies. Until next time, diversify wisely and invest smartly.